Traders, good morning. TGIF and welcome to September. And do I have a special guest star today? Stelios?
Good morning.
Hey,
Hello.
good morning. How are
How
you?
are you? I'm very well, thank you. Very
Are
well.
you on the islands or on the mainland?
No, we are now in mainland. It was a really nice couple of weeks, but we're
Very
back.
nice, my friends. Very nice, very nice. I hope you enjoyed it with the family time. Always the most important time in life.
Yeah,
Much
it
more
was.
important than markets.
Yeah, obviously. No, it's all great, all great. Now back to the grind.
Yeah, nice stuff, mate. Nice stuff. Okay. Ryan's off for today and on Monday, so I'm going to be your host. Glad to have Stelios on my side.
Yes.
Let's quickly run through a couple of the headlines and one or two developments that shook moderately for one and a little bit harder for the other one, the market. But let's first of all go over the global things. And one that moved the markets a bit overnight is in China. Again, they yesterday they relaxed some home purchase curbs that they had before, and they support the mortgage market that way. At the same time, they removed the price cap on new homes. That is more in an effort to support the developers over there. It may not please the home buyers, but they are trying to fix the problem from both ends. And in another effort to curb the Chinese yuan weakness of late, they scaled back on the FX reserve requirements, bringing the requirements down from 6% to 4%. And I'll have a look on the chart later, but it did make for the dollar China to break below our support zone around the 727 zone. We went down to 724. We're closer to 727 again, but I would argue that it's perhaps rather due to what is still to come on the US data front than rather CNH. I reckon once the NFP will be out of the way later, I'll talk about that. The market will form a better idea of what to do with the dollar to start September. Over in Japan, well, Suzuki doesn't seem to be overly concerned with the yen right now. He said, although they are keeping their stance that sudden moves are undesirable and that the market should move in line with fundamentals, he did say that the markets should set FX prices. So that means that they are not really concerned about the level as such where we are, but as we've been hammering on this for forever, really. It is the speed of the moves that drags them out of their hole and have them comment or, in the last resort, intervene. So for the time being, don't expect too much interventions. If the dollar yen puts in a couple of days on the top side with 150, 200 points per day, then we should get more worried. But for the time being, not really. And then just lastly, to stay in Japan, Prime Minister Kishida, who yesterday said that they are not really looking at putting in place another stimulus package, is just came out saying that they are speeding up the consideration. That's Japanese, right? Speeding up the consideration for more economic measures. We know that they are already going to support the economy on the energy prices again. So we look to be closer to yet another Japanese stimulus package, which, as we know, is watering down the government's finances a little bit more. Is probably going to raise their debt a little bit more, and is probably going to put a little bit more pressure, if so, on the yields top side, and is per correlation, since Bank of Japan and government said that they would work closely together, is probably going to put Ueda in front of another dilemma. We've heard yesterday about those Bank of Japan bots, and they're all talking about January, March next year. So they're really pushing back the can, kicking the can further down the road, and that's going to have an importance again for this afternoon. Over to the just a side note, the RBA. We know that low is done, his tenure is done, and Bullock is going to take over. But now there's more and more talks in Australia that they are looking at external members to join the council and the voting committee for rate setting. It's not written in stone, but it's something that I picked up on a conversation that I saw earlier, and that's going to be interesting because there's two ways of seeing this. Either it reduces the importance of the governing councils of the RBA, but the glass half full says that if you get externals, which are people like economists, perhaps CEOs of the bigger Australian companies in there as well, yes, there might be a bit more lobbying, but it may also put a little bit more equilibrium and exact balancing out of action on monetary policy. So it's a double-edged sword completely, but it could be down the line taken as a bit of a positive. We have seen that Norway is already acting a little bit like this as well, because they have even in their government people from the private sector. And okay, Norwegian krona has been hammered over the past years or months, but in fact, Norway is still not too bad a country because they are handling their business pretty well outside of currency considerations. So that one to keep in mind for the Aussie further down the line is something that we just need to keep in the back of our mind. In Kiwi land, there's been a bit of dust flying around. The leader of the opposition party said that, and they are actually the National Party. Kiwi land is having, New Zealand is having elections in October, and they are leading the polls right now. And they said that they would put the RBNZ mandate back to where it was before, and that is to solely look after inflation, not to have to care about full employment again. I don't think it's a very popular measure, but that would reduce some of the RBNZ worries to have that to take monetary policy too far, for instance. So that is another one to keep in the back of our mind for later this year, somewhere in October, November, if this National Party would actually win the elections. What else? This morning, coming over to Europe, Villeroy, the French member of the ECB, said that they may be close to a peak on the interest rates, but they are far from cuts. He clearly hinted that they may not go as far as the market may think, but they will stay higher for longer, and that he's usually a bit on the dovish side, I would say, but that puts them also in a setup that we shouldn't expect yields or interest rates to come off too fast there either. So slowly but surely, all those central banks are aligning themselves again to what we've seen. And we get less divergences in the actual timeline of monetary policy. So that's going to be interesting going forward, because we are going to have to look at where the differentials actually get kind of fixed if they're all on the same line. For the news, that is really everything that I saw, apart from one thing. And that brings us to the American continent. And we had a bit of a shocker yesterday, a shock announcement, and that came out right into the last fixing of the month. And that is that Banxico is going to drastically reduce the FX currency hedging program that they put in place in 2017, that they increased over the COVID period in 2020. And now they are going to reduce it drastically by at least 50%. They are also going not to renew when those hedges come to maturity. So that put a bit of a scare in the Mexican peso market. I'm going to come back to that when I will show the charts in a minute. Now, for news, I'm done. So let's have a quick look at, unless you have anything else.
Not the news, anything news items or anything. You've covered everything. Just a couple of comments. So on, first of all, I have to remind everybody, I've got a lot of things wrong in my life. I've got a lot of things right in my life. Remember when the Fed was effectively showing us that they're going to be pausing, and I was saying, I think it's going to be a stop. And then I said, I think every central bank pretty much are going to follow suit, no matter where they are in their cycle and how things are going. And this is exactly what we're seeing. And, you know, history repeats itself. The Fed is theoretically an independent, central bank, independent from other central banks for sure. But there must be some kind of coordination, and, you know, they speak to each other. And it goes without saying that the other major central banks pretty much all follow what the Fed do to an extent. So I have the same opinion that I had, months ago when the Fed was starting to show us that they were going to be pausing and eventually stopping. Regarding ECB members saying, we're not going to be cutting yet, it's going to be higher for longer, I take all that with a huge bucket of salt, because think about the alternative. Would they be saying, yeah, we're probably done and we're going to be cutting relatively soon? They will never say that. No. And it's not like they are held accountable to what they say now. This who was it who said they're not going to be cutting soon? I can't remember the name. What happens if they cut if they cut in 3 months? Nobody's going to go back and say, what the hell were you talking about, dude? So I always look past the words and I look at the actions, and the actions are showing us that the turn is basically upon us in terms of rates. I think that central banks are done. I've said for a while, I think the exception is probably the UK, even though the Bank of England is always dovish as much as they can. Inflation and wage growth is just running way too hot at the moment for them compared to other countries, for them to stop. So I think the UK have a little bit more to go. But overall, we are absolutely done, I think, with rates, unless, of course, we see inflation reaccelerating, which I don't think we're going to see in the next 6 to 9 months. And I've said this for a few weeks now. So I think we're at a peak in rates. And I think that the data has been horrible. German retail sales yesterday, Spanish data today, European data in particular has been really, really terrible. And I must say, US data as well has been bad. Yes, the employment data can mask and hide the bad things that are happening in the employment market, but only for so long. We've talked about this at length, so I'm not gonna repeat all that again. We obviously have payrolls today, and I think that's the last thing that's going to start turning. Employment in the US is the last really last fort standing, and I think that's going to go as well. So with inflation dropping, with data really starting to turn badly, how can we see higher rates? I really don't see that. So I stand by my prediction that I think we've seen a high in yields, and I think with yields dropping from here, probably going to support risk assets. although a recession or bad economic data theoretically are negative for stocks, but you know how it's been working for the past 10-15 years. Anyway, I'm not going to ramble on anymore. This is my general view, and I stand by it, and I still think this is what's going to happen in the next few months. Anyway, I'll stop there.
You just front ran everything that's going to happen in the rest of the show.
No, I didn't.
Thanks very much. Right. Looking at those data, and now I have to say what I would have said 10 minutes from now. As I've been saying on the latest shows, I'm going to take everything that happened in this job, in those job data out of the US in one big bucket. Okay, and I've been saying it. I think I won't, as I said, I won't really make up my mind about a dollar direction before I've seen the NFPs today, because as we've been talking about this for a length of time now, the jobs market is one of the last big dominoes that is standing in this in the US and as for a matter of fact, it's going to be for the rest of the globe as well, in the economy, right? So if that starts to falter, then we are going to have a problem, and then we are going to see the Stelios prediction come through, and that is that yields are going to tumble if that domino falls. If in turn it holds, then I think for the rest, or at least for the start of September, now I'm really front running time, for the start of September, we could see a bit of a continuation of the revival of the strength of the relative strength of the dollar compared to the rest, until we see the next probably inflation data. So I think today is important enough. Don't forget, we are the start of September. The people are coming back from holiday. The big hitters are probably getting back here, and they will do the same thing. They will take what we've seen on the yields, what we've seen on the on the GDP, what we've seen on the ADP, what we've seen yesterday on the PCE. And what we will have seen today on the NFP. They're going to take it all in and start to form an idea of where they want to go at the start of September and going perhaps into the end of the year, but that's maybe a little bit early, because lately, since the pandemic, we've got so much acceleration in all cycles that it's a bit tough to make predictions 3 months out or 6, let alone 6 months out. So those PCE data yesterday came out roughly as expected. Personal income a little weak, but then the spending is holding up. But we've seen those plastic spending going up a little bit. So the consumption numbers are not really a surprise. It did underpin the dollar a little bit, but yesterday was perhaps not the best point of measurement for dollar strength or weakness, because we were really at the end of the month, end of month flows. We've seen the fixing, we've seen a bit of front running of it, we've seen a bit of strange moves at the time, but really we are roughly going into levels where I think it's relatively neutral, or at a balance point where we could create an imbalance later on today. So this PCE didn't change much. We had a bit of better manufacturing, but still below 50 in Aussie land overnight. I'm going to have a look at those euro and those Aussie crosses as well a bit later, because it's interesting, since Aussie is surfing on the China wave quite a bit lately, and there may be some interesting developments there. Then we had the some more Japanese data. Not a lot to say about these. Capital spending a bit lower than prior, a bit lower than expected, but still a positive number. Not a lot to say there. Then we came into the we had this surprising manufacturing PMI number out of China. Okay. Right. I'm gonna leave that for what it is really. We got weaker housing data in UK. They were expected really. If we look at the articles that we saw late in the UK press, it's not a big surprise that this comes off, but we have to note they are pretty negative numbers. Not that it really had much of an impact on the sterling, but I think what's coming is perhaps more important, and the impact of the data will actually non-US data may actually be rather seen in the coming week than today. Today, the market will really be focused on what's going to happen with the NFPs. We've had the European PMIs, and look at this. Apart from Greece, well done, Greece again. I mean, the Greeks are going to save Europe. But Stelios, you are doing.
You have to congratulate my wife.
Oh yeah. Okay.
I'm
I
kidding.
hope you will survive. Your wife doing all the heavy lifting for the PMIs. But the rest is red. Okay, we had a just an as the flash numbers already showed in Germany, so a flat number, but this is really weak. A PMI below 40 is horribly weak. Okay, and the rest all missed. So the Italian GDP also just a tad, but also missed. Okay, so what's happening in Euroland, and we had this discussion, remember yesterday with Ryan, about are we trading inflation going forward, or are we trading growth? And you know my opinion. I'm of the second. I'm in the second part, and even though ECB has a price stability mandate, it's still a bit vague. And as we heard from other speakers in the ECB, they are getting a bit worried about the economic situation. So they are not only worried about inflation. They would be worried. They are worried about inflation because of the combination with weaker data as well. There's a big risk in Europe that we are going to take this big stagflation word in our mouth, which is usually not very good for a currency, by the way. So those numbers are a bit weaker once more. Okay. Where yesterday, which is not your main number, but yesterday, it's still a number below 50, but the Chicago PMI was a bit higher than the expectations were. So there could be this divergence building again between what's happening in Euroland and what's happening in the rest of the world. You know, you got a green, and still it's below 50, but you got a green number in Australia, for instance. You got a green number in the US, and you got all red numbers in Europe. Sometimes the markets are just as stupid as that. Just look at the divergence in the numbers, and you will see, or you will have a good idea of why a currency is moving in a certain direction. Right. Over to what is finally going to happen this week, which is the first big data point of September and the last one for this week. The NFPs. Okay, we are expecting as 100. Well, the wires are still expecting 170K. We have seen this week on the back of the other jobs-related data coming out that a lot of the analysts are already screwing back their expectations. We are not really, and the market is not really expecting 170K. It's more expecting somewhere in the region of 125 to 130K actually. So in the old days we had this kind of like dotted line where the average of job creations would have been somewhere around 180 to 200K was 200K was needed to create growth in the job market. This number is actually markedly lower right now. So I'd say get a number of above 100, 100 and above 100, 120K. This is not going to scare the markets, I think, this afternoon. get a number below 100K, then we are talking about something different here, all right? Get a number which is closer to the expectations here. I think that's actually going to be a positive just for the currency. And when I will have a look, and I'm going to switch off very soon to the yields picture, it's going to be very important. And I think it's going to be important not only for today, but for even next week or into the next big data points, okay? Because it's going to be important what's going to happen on yields today. I can't say it enough. So then we if we get like a lower number, there is a possibility that this ticks up a little bit to 3.6, 3.7%, for instance. If we get a bigger jump than this, then also the market will probably weigh on yields. And then finally, we have to look at the earnings. Again, get a big divergence of this number. It could impact things a little bit, but I reckon the importance is going to lie here because the market is expecting a slowdown in the job market now. It has been expecting it somewhere vaguely over the past months as well, but now we are really expecting a slowdown, but we are expecting a mild slowdown. And that we will also have a quick look today at the equity markets. We're also having the Canadian GDP numbers. It is expected a bit around the 0 level. I've seen calls for it to be a bit weak. I don't know what's going to happen, but dollar Canada is trading on the 135 mark. Of course, the US numbers will have an importance. But look at the Canada perhaps versus other currencies. If you get a beat here, there's a currency pair like, for instance, Euro Canada that you could look at with the weakness of the European data. If we get a stronger number here, if it's a weak number here in combination with a bit of a stronger US data point, this 135 zone could easily hold and reach for perhaps fresh highs. Okay, this for the data. Let's move over to the charts pictures. And first of all, let's have a look at the US data, US yields, because this is going to be important. This is going to be important. And we are bang on this, okay? 408, 409, it's very close to the market, but it's your level of, I don't know, it's going to hold or break. And then we are looking at levels very close to 4% below. And I would argue that if we get a really bad number, there's going to be little to hold this from retesting at least these low 390s, okay? I think it's important enough, the combination of all those data that we will have had today is important enough to pick a side here. If in turn you get a stronger report, that should be the surprise trade today, and then we may continue to see this hold up. We still can't forget that the US Treasury has increased their bond issuance program this quarter. We will have to take that into account as well if those data hold up, okay? And then even if you look at the shorter term picture, which is really the one that should be the closest here, the 2 years to what the expectations would be as well for what the Fed is going to do in the immediate. You can see here that since July we have been building on a bit of a upward trending channel. That if we get a weak number today, watch this 482.85 zone. If that breaks in combination with the 10s, I think that could be very negative for the dollar. And then we have to see how bad this number is, because there's one here that really has been, well, globally, all of them, if you take it the NASDAQ and things, have been defying the laws of gravity despite higher yields, but they have been really taking an enormous advantage here of the lower yield environment is the S&P. And we've broken above our resistance here. Well, there were several resistances, right? We said about the 44.40.50, 44.60, 44.80, and then the 45.10 zone. We've broken above, and now we're trying to hold around here as well. It's trading a soft landing. It's trading the Goldilocks scenario, right? And we really have to pay attention here, because bad can become bad at some stage. And I mean by that, if you really get a bad labor report today, which is going to catch up on other reports and confirm what the weakness that we've seen in other data, there's going to be an initial spike, and I don't know where this spike can take us, 45.35 or 45.55. For this to continue to push higher, we need a mild miss, in my opinion. If you get really a bad miss and yields collapse, this could spike initially and actually see a severe spike, but if really the jobs market is starting to roll over and going badly, I don't see any reason why you would buy a country's stock market if their job market is looking very sour. Thoughts, Mr. Stelios?
What do you want?
On the yields and on the equity markets and what I just said.
Yeah, I think, look, when the jobs market is deteriorating, that is definitely not good for stocks. That was the case until 2008. Since then, it's become a lot harder to judge. I think in the long run, not in the long run, but eventually, economics catch up with price action. So if we see the job market and the US economy in general kind of having a little soft landing, or however you want to call it, then I think that's okay. I think yields dropping will bring support to stocks, and I don't think we're going to see a big move lower in any meaningful way. But if we have a proper recession, if things start looking really bad, I mean, just go back to 2020 and look at what happened during COVID. I know it's an extreme example, but we had a very sharp move lower in equities, and the only reason they recovered was because the governments basically came in and threw the kitchen and sink at it and just threw money at it. And when you do that, then everything goes up. So, my view is that the market needs a correction in equities, definitely needs it. The question is, if yields are dropping, and especially if central banks are cutting, then that's going to be a very big hurdle. It's going to be difficult for equity markets to drop significantly if that's happening. So I think, go on.
Yeah, I don't think we can call that today, right? If central banks are cutting and the equity market will go up if they throw the kitchen sink at it again. But the question here really is that is a bad report going to be bad for the equity market? And because, okay, if we are in a Goldilocks scenario, imagine that we print 100K, all right? And that we just do 3.6 or 3.7 in the unemployment rate. I think then your stocks continue to rise, right?
Yes, I think the quick answer is a bad report for today or tomorrow or Monday. Bad report is good for stocks. That's the immediate reaction.
Unless you get a really bad report, which is zero or negative in the NFPs, right?
Theoretically, yes. But practically, what does that tell us? That tells us that the Fed is a lot closer to cutting. I know it's not going to be happening today, right? But the market, I think, might even take that as positive for stocks. I don't think that makes sense. I agree with you 100%. If the number is a little bit bad, I think that's good for stocks. If it's really bad, it should be bad for stocks. Yes.
I think if we talk like this, then it is like stocks will never go down, right?
Well, you know what?
If it's a good report, I mean, we have seen because let's face it, we've seen this is March, right? We went back down to 3,800 or so, and then we started. We had this big correction, during the yields going up and stuff like that. But then this is March, and then look at what the 10-year has done since March. It's only gone up.
Yeah.
And your equity market has only gone up. Well, okay, we've had this setback. You need a setback. Nothing is one-way ticket, but it's virtually only gone up. So if you are in that scenario, this thing can only go up.
Well, I'll go back to what I've been saying for ages, for years. For me, the main driver in the medium term, I'm not talking about moves, up and down. Obviously, nothing goes in a straight line, but the main driver is the change in money supply.
Yeah.
For stocks, for gold, for everything, for oil, for everything. Of course, you then have supply demand for the particular instrument that you're looking at. But if something is dollar denominated and there is a finite amount of it, and the money supply is going up, that will go up eventually. No questions asked. You look at the monthly chart on the S&P, you overlay M2 money supply, it's a perfect match.
But is money supply going up right now?
Right now, no. But if you look at the chart, it's a blip.
Yeah.
We're seeing now, it's nothing.
Yeah.
So anyway, and for me, money supply keeps going up. Why? Because we have a 2 trillion deficit every year. Maybe the Fed is not buying the bonds right now; they're actually selling, but that's going to stop. I mean, there's absolutely no way they can keep doing that. So that is a big picture. Of course, that doesn't help to trade today, right?
Yeah. All in all, unless we get a very deep recession, this is a medium-term buy on dip. But in the short term, anything can happen. Let's put it that way. All right, let's look at a couple of currencies. Let's do the majors first. As I said this morning in the room, we are around equilibrium or so level in the euro dollar, right? We're 108.5. That's close enough. The options market is not pricing much. And let's not forget that over the past few events, and you talk about central banks, you talk about pretty decent data, the option market was relatively right, okay? Give and take pips, not percentages. The give and take pips, the option market was really right. And they are again not pricing too much of a move today. The overnight straddle is trading at 55 points in the euro dollar. So that means that the option market is not expecting the euro dollar to trade outside of the tighter range, which is give and take 100 points, which coincides with roughly 55 points each side. 108.80, stretch it to 109 now, 108.90, 109, and 107.70, 80. And that is what the option market is expecting to do. Now, we are traders, and we always like to expect bigger moves. So assuming that we have a report which is outside of the expectations. So outside of the expectations today would be, I reckon, a number well below 100K or a number at or above the prior expectation of 170K. All right, we really are going to need that to move this market strongly, in my opinion. Then we're looking at 107.30-ish. I've been saying that in the room as well. If you take this as well, we are not going to be far from there, 107.30, and your 109.40.50. Those are your outside prices, in my opinion, where it's how I call it decision time. So either you hold these levels and we continue to, and this is going to start to look much more horizontal, or we break it. In case we break above 109.40.50, I think 110 is just around the corner, 110.5. If you break sub 107.25.35, give it algo pips. It's an NFP, okay? Then I think we are going to have a look at these prior lows that we saw in June, okay? But for that, we are going to need a very good report, which is the surprise trade today, I would say, okay? For the euro dollar, it may be less obvious because of the weakness in the European data. For the dollar yen, though, we are back on not too far from our 145 line. And there we have two things, right? Today we look at the dollar side of things. But if the report would be a bit better, then you have to think about what the Bank of Japan and what the MOF has been saying lately. That means we're not close to interventions, and we are not in a hurry to change anything. In which case, if you're going to beat here, that one is probably going to shoot back above 146, 146, 10, 20, and we may have a chance to get back into the high 146s. It's going to have to be a really good report to get back to those prior highs, in my opinion. And it's not a base case, right? With everything that we saw in the job market, it would be a bit suspicious if we get a 250K print today or 300K, you know. I would call it a bit suspicious anyway, or if the unemployment rate goes down. So, but if the report is good enough, then the market is probably going to think about, hey, those guys are not ready to intervene. We still have enough differentials in the interest rate. It's perhaps going to hold this dollar yen, okay? If in turn we get a really bad report, no, we didn't do cable yet, Brent. If in turn we get a really bad report, I think 145 is going to be toast once again, because those support levels that I showed on the US yields are going to probably break, and there's a fair chance we are going to be looking at low 144s, mid 143s. Okay, I think the number this afternoon is important enough to create such moves, right? And we are going to look at the cable, and at the same time, I'm going to reply to what Ali said earlier. The question is, I'm long. You're saying that you're long Euro-dollar at 108.46 with a stop below 108.06. Well, I hope your broker is going to, if you want to keep it over the NFPs, I hope your broker is going to give you a guaranteed fill, because it could really move very fast. Okay, I'm not having any positions ahead of the NFP. If I would have one, I would reduce it to really a skeleton position, or be flat into the NFPs. I think the number today is important enough for watching it and see what we need to do, or what we have to do with the dollar. Okay, so then going over to the cable, again, 126.15.25. We've seen the break the other day. We went down to this 125.5 support zone. It broke down inside the channel as well. It was a decent one, but then we quickly reversed it, and this looks like a false breakdown for as long as it holds. Okay, if you get a really good report today out of the US, this is probably going to be trading back to those prior lows. If we start to see weakness in the jobs market, 127.30, 127.60, 127.90 figure. Those are your levels to see. And I would argue that 127.90 figure is your 109.40.50 in the Euro-dollar. If that starts to go, then it's, I reckon, decision time, and then we could actually trade a bit higher in this cable. So that for the majors. On the Aussie, we did go above the 64.90, and we just went close to the 65.20. I think the 65.20 is your level to watch, and then above 65.75. That's your equivalent of what we've talked about in the other currencies. Downside, well, simple. It's 64 the figure, really. If you go down below 64 the figure, then we probably going to try back 63, 65. One thing we have to say about the Aussie, and therefore I'm going to take you now to the dollar China, because Aussie is still trading a little bit on the bandwagon of the Chinese yuan. We have seen Aussie through the crosses hold up pretty well, thanks to what's happening in China. And this is what happened in the dollar China when China cut their FX reserve requirements. We went down all the way to 724. We broke this support here around 727. We're trading around this trend line now. So this is going to be decision time for dollar China as well, whether the market buys it or not into next week. This could actually go and have a look lower if the market buys the China not reopening, but buys what the Chinese government and the PBOC are doing to support their economy, so that that is going to impact your Aussie dollar as well, and it's going to impact another one here, which is your Euro Aussie. We've been looking at that in the room here. If the Aussie finds enough support in combination with the weaker European data, this could be one that is ready to perhaps have a look lower, okay? That's what we've been discussing in the room today. It's the possibility, all right? For as long as you stay, this is starting to look a bit heavy. That is what we've been talking about. I think a lot of it, Ali, you're asking about the dollar yen. I think a lot of it was end of month, mate. There was the acceleration was pretty clear towards the London fixing. That is the main the main reason, and a bit of Forex textbook. Okay, moving on. Question from Roberto Solari in our Q&A. Any thoughts on what caused the FTSE to sell off sharply yesterday and rebound today? Solari, have a look at what happened in the UK short end. Just quickly. No, it's not US, it's UK. Have a look at what happened over the past sessions, and we think it has to do with some perhaps future contracts rolling, and we had a pretty sharp drop in the UK short gilt futures, so higher yields for some, to us at least, inexplicable reason. And we think there's a lot of month-end stuff that went on through there. Yes, lack of liquidity, volatility in their end of month stuff, and because nothing happened in the longer term. I don't know, Stelios, you having been a short-end trader in rates, can you put a plausible explanation on this? Or is it just end of month and rolls of contracts and stuff?
It has to be. It has to be some. What is this? Is this a continuous? Hold on, because it's not.
If you look at it as a longer end,
I think I know. This is switching, right? This switches to another reference bond, doesn't it? This is it's a continuous. It's not a continuous thing. So basically, you have certain 2-year, 5-year, 10-year bonds, and then you switch from one to the other, which is the reference one. So I'm guessing that's what happened, but I'm not sure.
That was our best guess as well, because we didn't find any plausible explanation for this one.
No.
In news or in data. So this must be it. Okay, so that's
because you have like a 2-year bond, right? And that's a 2-year bond, and as months go by, that will no longer be the reference 2-year bond, because it becomes shorter. So you go to another one, and further out, the other one has a different yield. I mean, I don't know.
But I think we are not far from reality there, and I think, Roberto, that's that's also what's been happening in the FTSE, All right. Okay. So Ali, I reply to that. Mostly fixing month-end flows. I think that's the most plausible explanation as well. Then the last one, and I know I'm taking a bit of time, but the last one, we have to look at it, right? We have to look at what happened in this mix. So yesterday we had this surprise announcement by Banxico saying that they are going to stop rolling over those famous currency hedges. And it really spooked the market. We're trading 2.5%, no, actually 3% weaker now, 3% weaker on the Mexican peso. The market thinks it's a signal from the Banxico, and it may be, that they think that the Mexican peso has gone far enough, that it's perhaps a little too strong right now, that there's a bit too much speculation in the carry trades, there's perhaps a bit too much speculation in just yield traders, which is there's a nuance between carry trade and people just trying to take advantage of Mexican strength and stuff. They have about $7.5 billion equivalent in this hedging program, which is so they're going to let 50% of it roll off, which is give and take $4 billion. Does it have to change everything? No. Does it scare the markets? Yes, because the weaker ones who were just blindly trading Turkish lira, Mexican peso stronger, they're getting a scare here. Because it may signal that the Banxico is even perhaps closer to saying, like, now we think the Mexican peso has gone far enough. Inflation is at least stabilizing, if not trickling down just slowly. It may signal a couple of things, okay? So we have to pay attention to what's happening in the Mexican peso. I'd say globally, it doesn't alter the economic picture in Mexico. It's still a manufacturer. How do you call it? Nearshoring or something is still a bigger manufacturer now for the US and for other countries as well. Investors have been piling into Mexico. Are they going to change? Not today or tomorrow. Do we need to keep an eye on it? For sure. All right. So now we are back into a first level of resistance. If you look at the longer term, not a lot has changed. We have seen these kind of moves in the past, okay? But the longer term picture hasn't changed. We are still really inside even a shorter term channel. The longer term is really not being challenged unless we go back up to 18 in dollar mix. Do we need to pay attention to this? Yes. I just repeat, yes. But I think next week will tell us a lot more to see if the Mexican peso is still that strong currency or if we have to worry about what's going on in the carry trades. I'm flat. I've been trading the MEX for a long time with really good success. Yesterday was a bit of a strange one. I nearly got burned on this move, but luckily I wasn't stubborn and I got out of it. And that is it for me for today, unless Stelios, you want me to look at something else.
No, that's all good. I just want to say one thing for those who have been following what I've been talking about with silver. I took off 1/3 of my long today, 24.50-ish. That's from 23.09 ahead of the numbers. I'm still very bullish, but you know me. Last time we hit these levels, I took 1/3 off, and then it went right back to the low 23s. I reloaded. That's what I tend to do, just reporting this. And obviously, I put this in the chat room as well for those of you who are members.
Yeah, I think it's we're actually at a pretty important crossroad, perhaps as well. Yeah, over there. Imagine that the market buys the Chinese revival. That the market thinks that China is doing now enough to at least start to revive their economy. I think this one is going to absolutely rock it.
Yeah,
that's what I think anyway.
Yes.
Ladies and gentlemen, stay safe. Be very choosy. Choose wisely what you're doing. Let the numbers come to you. Let the market come to you. Don't rush into anything. My levels are not the absolute levels. Everybody has his own levels. Do your own research, but be careful. I do think those numbers today are important, especially seeing that the big hitters are probably getting back into the market, and even more so next week. If you can't catch it today, I think next week is going to be a pretty cool market as well. Enjoy, have a great weekend, and we speak to each other on Monday. Thank you very much.
Thanks, Kay. Thanks, everybody.
Thanks, Stelios, for being with me today. Have a great weekend.
My pleasure.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.